Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Joining us on the show today to cover a wide range of topics including commodities, natural resources, and main takeaways from the earnings seasons is Portfolio Manager of Global Natural Resources, Joe Overdevest. Joe gives an overview of what's happening in the economy. He notes the U.S. economy is doing much better than Canada's. There is a focus on technology where corporations are seeing where they can spend on new technologies, including AI. Resources in general are doing well, but he says they are mostly dividend and buybacks that interest shareholders in this industry. Joe also touches on oil, energy, and metals like copper. He comments on the short versus long-term investing strategies. He says the thought there is that copper and oil will perform in a short-term period. The main driver is GDP. U.S. GDP is a driver for energy, and China's GDP is the main driver for base metals. The long-term perspective is that governments want to go carbon neutral, while energy companies might not feel comfortable transitioning to that. In Canada, we are waiting to be carbon neutral, even if Canada is a leader in the energy sector. This podcast was recorded on May 27th, 2024.
A bit of a snapshot on the earnings front. They've generally done quite well. We're just getting into sort of the industrial story. What are you watching as sort of a narrative, would you say, from earnings?
I think the narrative from earnings is really a reflection of what's going on in the economy itself. As economy, the U.S. is doing a little better. Canada, is probably doing okay, 0 to 1% growth, and then the U.S. is growing kind of more 3%. But probably still we're seeing is that, technology-wise, a lot of big corporations are focused on where we can spend in technology, and I think their needs are, I'm sure you'll bring up AI, they're probably more in the thinking about AI and debating it depending on the actual industry, but not going full tilt at this point in time. It's more the learning stage. Again, all depends on how adaptive they are, but definitely almost all of them are learning at this point in time. I would say resources in general are doing well, but again, they're pretty boring at this point, dividends and buybacks. The Canadian banks are just going to start the reporting season right now. One has already gone. And they're probably seeing slower growth, and they're seeing, credit losses creeping up a little bit. But the actual housing environment is still very strong because of immigration in particular and just population growth. So if housing and jobs are decent, the banks generally do okay.
So let's go into a little bit the commodities story. One of the really interesting things that I'm sort of watching from the sidelines and you're watching in depth is the story of consolidation, because it's an interesting time where the deglobalization story has been unfolding for some time. A lot of countries or partnership countries are trying to make sure that they have supply close to home, not further afield. And we are seeing consolidation. Just sort of, what is that all about? That's about sort of a capital expenditure story. Would you say it's expensive to do this? Why are we seeing so much consolidation?
You saw a large amount of consolidation already on the oil side probably last year. And for the listeners here and the watchers is that you haven't seen really in the materials space much M&A for probably last almost 15 years. And you saw, of course, two major companies now talking potentially to merge. That is a big deal, and a big deal. So already on the oil side, you saw some majors get involved. Now you're seeing on the materials side. I think it comes down to, we just had a group come back from Texas. They were there in Houston. They were all the way to Permian all week last week. And the thing is, especially on the resource side, there's two different subtle things. But say on the energy side, if you're a board of directors or CEO right now, how comfortable would you feel putting a huge amount of capital into the ground for new projects? Not very good. And some of the big ones is shareholders are telling you, we just want dividends and buybacks. Number two, the governments around are saying, I don't really want you to invest in resources, not in my backyard. And number three, they're just still looking at society saying like, well, where is the peak in energy? So if we're not feeling comfortable about that, how could we invest? So if you have a lot of cash, guess what happens? You do mergers. The copper or more base metal side is a little different, is that when we talk to those CEOs, is they actually feel very confident about the supply demand going forward. That's not the problem. If anything, that's exaggerating potential M&A desires. But number two is like similar in that they actually can't invest much. They go to a lot of countries and again, number one, not in my backyard. And number two, it's just very costly. The mines that are left that haven't been developed are not cheap. And so they're starting to look at the buy versus build. and that you're starting to see the first signal that it's actually probably better to buy assets than build them.
Well, and where? I mean, that's sort of the other piece of it, isn't it? It's the jurisdictional story and really the jurisdictional risk. We're talking a lot about Canada, North America, and other sort of partner and ally countries coming together on this, because it's tougher and tougher to have mines maybe further afield.
Oh, exactly. And so again, on the resource side, we just had an amazing industry review. We do industry reviews on a periodic basis when we think it's beneficial. Jin, who's our energy analyst, did an industry review. Where do we stand in Canadian energy? And one of the best charts he had there was resources around the world of oil. Saudi Arabia, Iran, Iraq, Russia, Canada, US, and he highlighted where you could invest in and where you could not invest in. There's a lot of big reserves out there, but you could not invest in them, right? Sorry, Pamela, you were saying.
No, I was just going to, is it kind of a small universe that you can invest in? I mean, is that what it comes down to?
There's big numbers, but when you actually start cutting them back, it's a very small number, right? And so again, it shows that probably it's US, it's Canada. Recently, it's a little bit in Ghana. But like, other than that, it just falls off a cliff. And of course, on the copper side as well, is that these mines, the ones that are left, are very high cost. In some cases, they're in almost a rainforest-like area, or places that, the locals are definitely not, wanting a big open pit mine that actually also may disrupt the water systems around there. You can imagine this is not like it's visually, in some cases, it could be an eyesore. And so it's where you actually start going through and going, okay, when can we get a permit here? And then the odds are, maybe in 10 years, maybe like if the government allows it. And even then, it's like, what are the confidence too? Because once you start the mine, mining CEOs will warn you, you may start the mine, you may complete the mine, but on day one is actually the most dangerous day, because now you've already built the mine, you've invested all the capital, and then the government may say, we want more money and we want more taxes. And as a mine, you can't walk away from that. You've already committed the capital. So we've been doing this resource investing for a number of years. 15 years ago, it seemed a lot easier. Today, it becomes a lot tougher, where you're going to deploy huge amounts of capital with confidence.
So it's interesting. It sort of brings to bear something that I think you and I have spoken about, maybe more in like off-air discussions, but this idea of the short-term versus the long-term investment, because you can kind of see the short-term a little bit, and you can see the demand, but then at some point, is there almost a demand destruction that often happens in the commodity story? But tell us about the short-term, long-term.
Yeah,
dynamic.
I think it's a great question, Pamela. And so, in the short term, people often want to say, where's copper, where's oil 6 months now? Look, it's very tough, but I'll tell you the next, say 12 months, it's going to drive copper, oil, or whatever it may be, all these commodities. The biggest one is just GDP. The big drivers, of course, are US and China. China more so for base metals, more so US for energy. The US is doing okay, give or take 3%. Again, we'll talk about interest rates. That's why interest rates are generally, staying higher for longer, because the economy is doing well, in particular in the US. In China, it's doing all right. It's slowly improving, but I would say it's not a smooth ride, but they're slowly getting their, growth back. But it's pretty anemic. What I would say, though, it's really interesting, the longer term is that energy, I would sum it up as, again, the energy producers and the governments are still not at the same table. And this is where it becomes interesting if we look at the long term, is that everyone government-wise wants to go carbon neutral. But if you're not sitting down with the energy companies don't feel comfortable where they fit in this future, they're not going to invest. And are we going to have a nice clean handoff? Microcosm of the world is the whole Canadian government and the producers here in Canada want to be carbon neutral with the oil sands and do carbon capture. That was supposed to have been done with an agreement, maybe even last year. We're still waiting. So again, Canada being probably a leader in energy, we came in ourselves, get together to decide how we're going to do this for taxes and invest in incentives and investing. The other one on copper is really interesting, is that if copper or oil, if we look back historically, when some of these people ask, well, oil 150, what happened?
Yeah.
So everyone knows that when oil goes to $150, what's happening is that you cannot get enough supply in the short term. So no matter what the price is, you can't bring on supply quick enough. And so what happens, instead of an incentive price, because what happens is there's a few things. Cash cost is when things go bad. The cash cost is when you shut down the mine or shut down the oil and gas well because you're not making money. That's the floor of your price. The incentive price is generally over time. where a commodity should be. Because a commodity, again, hence the name, it's going to be around the cost of capital because you can bring a lot on. So for oil in the past, it was like around 60, okay? Then why would oil ever go to 150? It goes there because you can't bring enough supply on quick enough. So you can't adjust supply. Back in Economics 101, hopefully everyone was awake in class, you have to destroy demand. And so all of a sudden, that as an investor, that's why we're having Jen, a lot of these resource analysts do a lot of updates on their commodities. You don't want to be asleep at the wheel, because we did that in 02 to 08. There was a big move in commodities, and it went from marginal cost to actually demand destruction. And demand destruction means, for the audience, is that when do people change their behavior? When does Pamela go, you know what, I'm not going to the kids' soccer game. The tournament is too far away because the gas price is too high. And when we look in the US, it's probably one of the biggest examples where we see behavior change when oil got over, like, say, 125 to 150 historically. Copper will be probably even higher than you think because we just don't use it as enough. This audience knows the price of oil or gasoline. Very few people notice it in copper just because you're not using it as much in your daily life. You don't really notice it in maybe your car or just, essentially electrical things in your house. But there is a point as well, and it is a higher number than we are today. But that could be, if that happens, you'll see huge returns for all the commodity stocks.
So first of all, Pamela might not put gas in the car to go to soccer just because it's rainy. But in any case, what the heck about gold? Now, gold is and isn't a commodity, and I understand it's different. But I mean, it doesn't seem to have any barriers to where it's going at the moment. I mean, what do we make of that? And particularly in terms of investing in it.
Yeah, you and I have been talking about gold for a long time, and so again, for the audience, it's essentially it's an alternative currency, and so a lot of people for the audience get frustrated, like, well, it doesn't just come down to supply and demand, and why is it up and why it's down, and again, all the things that we've been saying over time, I'll just review for you of it's how an upside down world we're living potentially in gold right now. So I told you interest rates are stubbornly high. The U.S. economy is doing well, the stock market is doing well, and the U.S. dollar is doing well. All those things generally would mean gold should be doing bad, and it is not. Gold is actually up and doing quite well, and the gold stocks are doing quite well. And I think this, again, it's interesting that and that's what makes investing in the world, very intellectually stimulating. It's not always the same. There's usually these little subtleties, and sometimes we call the butterfly effect. At the time, it doesn't seem like a big deal, but it could lead to a tornado somewhere else. And so the example would be, I still remember very vividly, it was actually a 60-minute show when a US official came on and said, we're going to freeze the Russian assets. We're going to take all Russian assets, anywhere, treasuries, any assets we can get our hands on, and we're going to freeze their accounts. And at the time, I understand why they were doing it, but I remember thinking in my head, like, ooh, there could be this could be something bigger for other reasons. And the reason why is that potentially what's playing out now, all countries around the world saw that as well and said, well, hold on, so if the U.S. doesn't like our politics or something we do or some conflict, can they just take all of our money? And, because again, people I don't think appreciate the U.S. is essentially in some ways the banker to a lot of different other countries, and a lot of countries, especially U.S. treasuries, are used as kind of like a holding of assets. And so potentially over time, again, this is something usually doesn't get reported because, again, these are big countries moving assets around. They're not using ETFs. Potentially on the margin, they're buying gold as a differentiator because gold is probably one of the oldest, again, reserve currencies around the world. For a long time, it was not being used the last few decades. It seems there's some buyer in the market for gold for sure, and it's not the ETFs. And you're even seeing it bubbling up. I'm sure you'll ask about Bitcoin. You're seeing it bubble up in Bitcoin. Now, Bitcoin is probably not sovereign nations probably buying in a large degree. They obviously could, but usually it's not a liquid enough market. It's not probably had as long as a track record to make them feel comfortable. But it probably, for the similar reasons of gold or Bitcoin, is you do see individuals say, you know what, there's a lot of stuff going on in different nations. I'm worried about my currency, wherever nation I'm in. There's a lot of large deficits. And again, these deficits usually need to be, paid off at some point with higher taxes or cut back in services. And guess what? Governments don't like, cutting services until they really, really have to. They'll probably raise taxes. And we're seeing that already in Canada a little bit with the capital gains tax. And that's the, the first step. But I think what you're seeing with Bitcoin and gold is on the margin too, is just individuals saying, you know what, I'm not maybe super comfortable with the currencies of wherever country I'm in. I want to differentiate a little bit.
I think it's so fascinating. I want to move on to AI and some of the tech players actually in Canada where they look good to you. But there's a question here about whether we are in a commodity super cycle. We know that that's what it was when China demand was really was the demand in the story a decade ago. But what about now?
Look, I'd love to say with certainty, but the problem is right now we're just a little early on. And the reason why we're really early on is the ingredients are definitely there. But we're probably, if history will look back in history, is history was telling that this is probably the beginning of it. But why I have to say, you can't say for certain yet. There's a number of things that can interrupt this, right? So obviously the economies around the world weaken for whatever reason, interest rates maybe slow things down. The other thing you just have to watch, depending on the commodity, is OPEC right now is a large amount of supply. And so when we look at different commodities, copper definitely looks better than oil. And just because there's no big amount of like OPEC capacity can come on the market. And over time, that should come on the market. They're just holding back supply. Copper, you're definitely seeing it tighter on that side. I think that's, again, for the audience, is that we saw last time it was China was a big driver of growth. They were buying all commodities. This could be a little more nuanced, where essentially, especially copper, is something that, you know, if you're going to have to electrify, go to carbon neutral, that has definitely been needed almost by every country. Whereas oil is just essentially like a little less of a strong demand. It's more just like the elongation of the demand and an anemic supply side. So just not the same kind of like driven growth that we're seeing on the copper side. So there you go.
Actually, I was going to move on to AI, but I have one more question on this one. A lot of discussions about LNG.
Yep.
In this country. And there have been a lot of discussions about LNG for 20 years. And 20 years ago, I think people said, oh, we missed the boat. But now we're talking about it again. Surely we've missed the boat. No?
Well, I think LNG is interesting too, because if you and I have been doing this so long, that at one point LNG was supposed to come to the US, and now LNG is leaving the US. So we're or at least more so, that's where the growth is actually leaving the US.
But really, has Canada missed all the contracts are all like 30-year contracts, and like, aren't they all taken? Do we have an industry here?
We do have an industry. We're doing some, of course, in our West Coast. It's be coming on in the next 12 months to 2 years. It has been delayed for a while. The US is also growing their LNG. I think that we definitely missed some of it. The US is probably a little more aggressive with permitting and allowing LNG, but we can still be a player in it. It's really a big part is a decision by the governments. Do they want to allow this or not? Again, a lot of it's back to permitting. The oil and gas companies have lots of capital. That's not the issue. And there's definitely still buyers of LNG throughout the world. Right now, the actions, at least of the current government federally, is that they're not the most aggressive, maybe, to allow permitting of new oil and gas projects. And we'll see. The Liberals change their mind, but also we'll see if we have a new government as well. And so that's, again, one of the interesting things about investing. Governments do change, and the rules of investing will change around with it, especially for resources. So we are pretty slow to do it, and but we can, catch up for sure.
Yeah. Okay. That's good to know. There's still room and time. Let's talk about sort of AI in Canada, kind of the tech players. There's been a bit of a discussion, I think, from Mark Schmale as well, saying things like, it's going to kind of the, not ancient techs, but like the old school techs, not Nortel or something like that. But there's some interesting opportunities for AI with kind of legacy tech, right?
Yeah, and I think for the audience, hopefully you hear Mark. Again, we were talking different podcasts, Pamela and I, before we came on. And, Fidelity Connects is one that even our investment team, we listen to a lot. And hopefully you listen to the Marks and Wills and Darrens, but also take time for Connor, Chris, Dave, and Brett, the very young investors, but very, very smart, and the next generation for sure. When it comes to tech, I think Mark does a great job. He's arguably, my humble opinion, the best tech investor in Canada, and probably, I guess we'll let someone in the US decide if he's the best in the US, but he's pretty good. And so when it comes to AI, I think what's interesting is everyone talks about, the first derivative. There's a lot of companies, it's probably this audience knows the tickers themselves, and the picks and shovels. And I think definitely that's the first level of it. I think with Fidelity, we're trying to always kind of sniff out here is that, what are the next derivatives? Who will get the gain and who will have pain in these kind of transitions? Because whenever there's change, there's going to be great opportunities on the investing side. I think what's interesting is, the white labeling. And so there's a lot of products for a long time where was old tech, and they essentially were providing networking equipment. Again, back to almost the 2000s days, some old tickers that we haven't heard from a while. And they just still to this day operate, and they're doing networking equipment or just helping essentially companies build computer systems. Well, guess what? With AI, there's just so much demand of building essentially, the actual equipment. And that's the thing, it's not just software, it's actually physically, this is what's changed in the last few years. You have to physically, build out data centers. All this equipment is needed now. And so you have some companies that were for a long time trading at 10 times multiple. Their earnings have been flat for 10 years. All of a sudden earnings go up 100%. And then all of a sudden people start saying, well, maybe the multiple should be 10 times because their customers are growing. They're all the hyperscalers. Maybe we should go to 15 or 20 times. And so that's where I know as a group, we're really trying to hunt as a pack to see where we can find some interesting opportunities. And there's some in Canada and there's some in the US for sure.
And the data companies, like traditional data companies as well, just because obviously AI is sort of hoovering that all into their systems themselves. So actually at one point there was a question whether some of the traditional data companies would almost get taken out by AI, but in fact they're going to be feeding the system. Just talk a little bit about kind of the opportunities for large scale data companies.
I think that's a great point. I think, again, for everyone says, just AI. And I think when you actually talk to CEOs, there's a few big things they think about when they're talking about AI. And again, there's probably more at the learning stage right now. And one of them is, security. And so a lot of them are actually saying, there's some public comments made by some of the bigger players. And one of the interesting quotes was, right now you're bringing your company to us as AI providers. We need to bring AI to you, which means is we need to have AI behind your firewall. We need to see all the data if we're going to do this. Well, there has to be a big trust there. And so that's why you're seeing really the bigger players dominate, because it has to be someone you trust to give up that data to AI. But to your point, number two is you have to, number one, trust who you're working with from a computer, some software AI provider. But number two is you have to have the proper data. And I think a lot of companies don't have data. And it's amazing, there's some companies in Canada that do software for, lawyers or accountants. Well, that's a great resource. They have a huge data set. And then if they overlay AI on that to the lawyers who use it in particular, they know they can trust that data. Think of a lawyer getting paid, a certain amount of money. You can imagine they just don't want to have some AI model that's running off public data that someone hasn't vetted. Right?
Like any old data, because every company is collecting your email and your data and your age, but not just any old data.
Yeah, exactly. The audience here may play with ChatGPT, which is fine. But when you're a company, you want to make sure the data we're running off is our own data or someone that we definitely trust in a major way. And so trust and the data, I think, are very, very important things. And that's why I think you'll see the industry leaders of software, but also data providers will probably be the first taking advantage of, as opposed to, there's just some startup who's just going to kind of disrupt this. You can imagine a big company going, whoa, I am not handing the keys to my company over to just some startup.
Yeah. And in theory, it should help to clean, how does it work within the banks? We hear the banks are kind of building their own. It's going to help them with kind of the back office. There's lots of discussions of money laundering right now going on. It's going to help them sort of do things better, more efficiently. We assume this is kind of an in-house thing. Is that right for the banks? That's what they're talking about?
Yeah, definitely. I think the banks, I think you'll hear more about that discussion, is that they're pretty excited because, again, they have so many opportunities from a cost side and revenue side. They're big companies, right? And they're a microcosm probably of a lot of other companies. When you have a big company and all of a sudden this new technology comes in, you have to at least analyze it. You can debate, is it going to be meaningful or not? And that CEOs and board will debate that. But you have to definitely decide because, as actually Mark alluded to, if you are a laggard in this and all of a sudden someone takes advantage of it, you could be in a pretty tough spot. But I think for the banks, it's example of what AI really potentially could be for many people. In a static environment, it's great. So a static environment, it means is very simple ones and zeros and, it's a tight sandbox. Fraud detection is a perfect example of that. You let AI or essentially some kind of machine look at all the data you have and see where there's any, something that seems weird. And they can do probably a pretty good job of that very instantly globally for the banks and say, something's weird and flag it. They can shut something off, they can flag it, wherever like that, but they're very good at fraud detection if it's programmed properly. But of course, when you go to AI, you have to understand that like where we are in this progression, the maturity of it, that's in a static situation. In a dynamic situation would be, so you allow the AI chatbot or someone that these days, if you teach AI, they can talk just like I do, and someone may not even know they're talking to it, which I do think regulation-wise, we're gonna have to get into. If you're actually talking to an AI on the phone, they'll have to disclose. Again, that shows how the regulations of the government are not there yet because the technology is moving so fast, but that's probably where it has to be. Hello, you're talking to Joe, the AI person, and then you call them up and say, I've lost my job. What do I do with my mortgage? What do I do with my credit cards? And allowing that situation, that's very dynamic, right? Maybe they explain their situation. Someone has passed away in my family. They were the income earner. What do I do? Just allowing the AI, chatbot or robot to respond to that may not be the best thing. And it's something that maybe you could see AI having an input into helping a human deliver that message or make that final decision. So again, I think the banks in particular, there's a lot of costs, a lot of data. That is like the feeding ground potentially for AI uses.
I just want to briefly come back. We're going to wrap up in a second and just take a look at the markets actually in a second, how they've been for the last couple of years. But just briefly on sort of the big initial players, like essentially what we were talking about is the Magnificent Seven. Now we're down to five, but their version of trying to power AI, essentially, what they're trying to do, is leading to actually a new commodity story. Just briefly take us through that, if you don't mind, and then we'll wrap up.
Yeah, it's great, Pamela. I think, again, it's amazing at Fidelity. I love working with lots of individuals here. Again, we use the reference hunting in packs. And so whenever we see this change, and so it's really interesting, you're seeing the Magnificent Seven now doing deals to get energy. And in some cases, doing deals to do nuclear. I know we talked about this for a while. And it's amazing because what we get excited for is that, that industry of electricity actually has been flat. The electricity use in North America has been flat for a while because of all this, we've been more efficient, which is great. And also now with this AI potential movement, energy demand could be significantly higher. And you just can't move energy that much. You can't just move new supply of hydro, natural gas, nuclear here in North America. So someone's going to make money. There's going to be an economic rent that will go to someone. It will probably be utility companies. It will take time, but that's where we're doing some work on. Of course, we already talked about copper. Copper will have to use to electrify the grid. And I think even just companies here in Canada, I was talking to someone, recently, and it was amazing. This is why we have these meetings. And, we've had these companies we've met with over multiple decades, and the way they talk now, it's like they've never seen so much demand. And this was an electrical company. They actually have electricians. And they've never seen so much demand just for, using electricians to build out these data centers and to electrify the grid. And so a company that's been growing, very low, all of a sudden goes very high. This is things you want to get excited for. So to your point, I think it'll be multiple companies will be affected from it. It'll be probably more in the industrial space. And in particular, it'll be slower, but in the utility space. And of course, we mentioned uranium as well.
Yeah, amazing. Just got 30 seconds left here, but it's been wild markets since COVID. I mean, come on. It's been a little bit of everything. Just walk us through, like, if you look back, just take a breath, look back. A lot of things have done well in the markets. There have been things that haven't done well, but there have been sort of interesting opportunities for, best part of 5 years here.
Yeah, no, I think you and I were doing this a while ago, and I was in my house, and because I wasn't allowed in the office. And so, look, the last 5 years, S&P 500 has compounded around 15%. TSX compound around 10%. I think so much of the audience and different investors debate timing and different things. And let's review the last 5 years. You had Trump, you had Biden, you had low rates, you had high rates, you had oil negative, you had oil high, you had multiple conflicts, you had inflation high, inflation low. All during this time, depending on the market, compounded 10 or 15%. And again, probably, we've talked about different takeaways. One of the biggest takeaways is maybe I know there's a lot of time spent on timing the market, spend maybe a little more time on just picking the right horse. And what horse do you want to ride? Because the power of compounding is very powerful.
We'll leave it on that. Joe Overdevest, it's always such a pleasure to get your views and thoughts and insight. Thank you for joining us here today.
My pleasure.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.